Welcome to the fiscal year 2024 market update for Texas Vestments Worldwide LP. Every year in July, we shuffle our basket of stocks. We only invest in the largest companies in the US and Canada, headquartered in the US or Canada, by market cap. Um, they have to be in business for at least 10 years. They have to pay a dividend of at least 2% for 10 years without any breaks. So if they suspend a dividend or if they miss a payment, we can no longer invest in that company. So all these companies fit that bill. The other thing is the stock price. So we have to invest across all 11 sectors of the economy. Okay, so that's basic materials, communication services. We'll go through them here in a second. And so ideally, we want to be able to purchase at least 100 shares of each company within all 11 sectors. And so when I did the math this year, that came out to $91 per share price. And so again, we do this every year in July, and so this year we reshuffled. Some years we have more companies, some years we have less. This year is a little less, but there are some great companies that we've added in and some that we've had to take out. One of the big ones is a company that we just sold out of a few months ago that we had for quite some time, Southern Copper Company, which was in the basic materials sector. But we can no longer invest in that company because the share price has gotten too high. Okay. Um, and again, same thing. Company has to be headquartered in U.S. Canada. The reason for that is because accounting practices and also reporting is different for companies outside that are headquartered outside of the U.S. And we want to make sure that we have some congruency and some stability and some in our expectations of what we will get from those financial reports, because primarily that's what we use to make our investment decisions. And so these are all the companies that we have here. I did my very best to get at least 8 for each sector, which was kind of difficult this year. And so because of that, when I say the largest companies by market cap, what I mean is literally like the largest that fit all of our criteria. Okay, and so this year there are some companies in this basket of stocks that are not necessarily mega cap companies, but they are the largest that fit our criteria. A lot of the reason why we chose to do this is because what we want is market stability, right? Conservation of capital is really important. If we invest $100 into a company, we want to be able to get that $100 out, right? At any time. And so what that means is that we have to invest in companies where the stock price is going to remain pretty much the same. Okay, what that means is that these stocks are not going to go sky high, but they're also not going to lose a lot either, right? That's kind of the way it works. You can't have a stock price that moves up a lot, but doesn't also move down a lot, right? So these companies don't move up a lot, but they don't move down a lot. And so that gives us some stability. Now, another thing that we do every year is we find a new portfolio to follow. Okay, there are 50, I believe, portfolios, maybe 49, 49, 50, 51, something like that. And they're all made up different. Okay, and so what we have here is a from July 2023 to current. Okay, these are the returns for these particular portfolios, and this is including all dividends. Okay, and like I said, each of these portfolios are made up of different companies depending on their score. All right, and we'll get into what the scores look like here in a moment. But currently, this is the best portfolio performance-wise, right? And so we're looking here, and we can see that the return up portfolio is actually the absolute best from July 2023 to current. This one is a rolling 12 month. So this is only going back to what is August of 2023, okay? Because it's now September. So this is also not including any dividends. This is just price appreciation by itself, right? So it's just the stocks going up in price, not counting any sort of dividend, okay? Um, this is a statistical calculation, and this is based on the volatility of that particular portfolio. It's from month to month, how much does this portfolio go up and how much does this portfolio go down? All right. And so what we're looking for is something that does not go down a lot, of course. Okay. And we see that currently right now, that is this portfolio here, the dividend beta down. This is calculated by 33% for each category, basically. And then we see the M-score dividend down here, which is really close to the top, only 0.5% different. And the same thing goes for the high. This is statistically the highest return in a month, in 1 month. This is a possible return in just 1 month. The highest is 10.5%. That's the beta standard deviation. And we see the M-score dividend is probably way down here somewhere. Because again, typically, if you don't have, if the stock price doesn't move down a lot, it's also not going to move up a lot. And we see that here in the beta standard deviation portfolio. Now, what I like to do is I like to look at how these portfolios are performing to try to tell me something about what's happening in the market. For instance, the beta standard deviation portfolio is made up of companies that over the last 3 years, and this is 3 years up to July 2023. Okay, so we're talking June 2023 going back to roughly June 2020. All right. In those 3 years, okay, these companies have performed better when the market is performing poorly. All right. Same thing with the standard deviation or volatility measurement. This is the last 3 years, June 2023 to June 2020. These companies did not the stock price did not move up a lot, and it did not move down a lot. Okay, and so we have scored 50%, 50% to come up with an aggregate score, and that portfolio is made up of those companies. And this is how this particular portfolio performs. Okay, so from July 2023 to current, this is including dividends, it's returned 3%, and on a rolling 12-month basis, going back now August of 2023, it's performed at 3.5. But it is very possible for this thing to return 10% in any 1 month. All right. Take a look now at the general market performance over the last 12 months. And when I say market, I really mean this particular basket of stocks. It's about 100 stocks. And again, these are the largest dividend payers, been around for at least 10 years. So it's not inclusive of the total market. But these particular stocks, take a look at this number. This is really what's important. I need to kind of color code this, I think. So 73%, this is September, okay? September this month. 73% of the companies are above their 200-day, 68% are above their 50-day. All right. Last month, 42% were above their 200 and 11% above their 50. So as you can see, that's a pretty big jump, right? Going back to July, 45% above their 200, 27% above their 50. Now, one important thing to note, and you can go back here. Go back. We can see in every case, the 50-day is below the 200-day. Okay, same thing here. Same thing here. Same thing here. All right. Now, typically, what this means is that when we say that 43% of the companies are above the 200-day, that means that 43% of these companies are doing better than they were doing a year ago. All right. The 50-day moving average is 27%. Only 27% of companies are doing better than they were doing 2 months ago. Okay, 50-day moving average is about 2.5 months. You can argue 3 months, right? And so when we have a higher percentage of companies doing better than they were 3 months ago, right, than they were a year ago, it means that right now, today, the market is doing really well. Okay, and that is what we call a buying opportunity, right? It means that the stocks are going way high, and at some point they're going to come down, right? But right now they're doing really well. Same thing goes when we have the reverse of what we have here, where the 50 is below the 200. It means that stocks aren't doing very well. Okay, and that's typically a selling opportunity. You want to get out of the market, and that it's probably going to continue to deteriorate, right? The opposite is also true. At some point, they're going to then go up because the market is up and down, it never stays constant, okay? Um, but I think it's interesting to go back and look at these. Again, here in October, we see we have another inflection point where the two numbers are very close together. And as we can see, it continued to do better than last year, but the 50 kind of fell off. 200 better, still fell off. And so again, we're at another inflection point. And so either the 50 is going to supersede the 200, right? Or is going to continue to underperform. So we'll get a chance to see what that looks like here in the next few months. And this is just a line of those numbers, just to kind of see visually what the market is doing. As you can see, over the last month, we have this huge jump here in our basket of stocks, and then from here we see a huge drop off. And so again, just up and down. Here from October to January, we see it's very flat, and that has really been the case for us this past fiscal year. There has not been a lot of activity, just mainly dividends and collecting some options. We did have some sales, but only like maybe literally like 3 or 4 sales the entire year, and that has a lot to do with our lack of performance. So hopefully, we see some numbers start to climb up and the market does a little better. But let's kind of see where things are going here. So this table keeps track of portfolio performance month over month, okay? But more importantly, it's the difference from month. So this 18% is not an actual return. This is saying that this portfolio did 18% better than it did last month, okay? All right, so we're looking at now the sectors. Remember, there's 11 sectors of the economy. This one is basic materials. 70% of the companies are doing better than they were last year, which is actually below what the rest of the market is doing. But 80% are doing better than they did a few months ago, which is better than 18% of the rest of the market. And you can see, again, this big number, negative, 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 and then a big jump up to almost 12%. Basic materials is typically something that does really well when inflation is happening simply because basic materials are needed for things to operate. You need metals, you need plastic, you need those basic materials, you need chemicals, all those things that you need to build and run our world, right? A lot of these companies, like I said, they are the largest. They're headquartered in U.S. and Canada, but they sell all around the world, right? And so, regardless of what's going on, these companies are going to continue to print money, basically. Now, what happens is if the economy is not doing great, right? And it doesn't really matter where in the world this happens because um, everything will affect everyone at some point, right? When Japan, China, and those companies uh, stop buying copper because they aren't building new things, right? They stop paying U.S. companies that provide them copper. Well, what does that mean? It means that the copper company in the U.S. is not going to do well. So world economics is U.S. economics in a lot of cases. But again, basic materials do really well in inflation because no matter what inflation is, the price of these basic materials are going to continue to go up, up, up. It'll, oil is always going to go up with the price of everything else. That's just the way it works. And there are some exceptions to that, but for the most part, that's what we're going to see. All right, communications, very much a consumer thing, right? Um, this is also involving um, some TV stuff, but for the most part, it's cell phones, right? So 29% doing better than they were last year. That is way below what the rest of the market is doing. 71% doing better than they were a few months ago, only better than 6%. And again, I think all these numbers are going to be positive. I'll be surprised to see a negative number in this September column for any sector. But that tells you one thing right there. Communications is not doing as well as basic materials, and that has everything to do with consumer spending. All right, consumer cyclicals. This is exactly what it sounds like, consumer, right? But it's also companies that typically make a lot of money in certain parts of the year too, right? So we're talking about companies like Hasbro, toys, right? People tend to buy toys around certain parts of the year. I think clothes can be put in this category. And we see a huge number, 16%. This may be the largest of all the sectors, not sure yet, but that's a big number. And so we see 80% above their 50-day, but only 63% are doing better than they did last year. So that's quite a mix. And that makes a lot of sense. It means that they're not doing as good as the rest of the sectors, but here recently, they've done really well. So the question is, will that drop off or will they continue to move higher? If they do, then I expect this 200-day number to get larger as well. And then the question becomes, well, why did those consumer companies move up as high as they did recently? I don't know. Okay, consumer defensive. These are again consumer sector, but these are companies where you will buy from them consistently all year round without ceasing. So these are going to be companies like Coca-Cola, right? There is no time of the year where people don't drink Coca-Cola. You can argue that maybe people will drink it when it's warmer outside, but for the most part, they drink Coca-Cola all year. There's also a lot of cigarette companies in this sector as well because cigarettes don't really have a time of year, right? So 63% above their 200, but 75 above their 50. This basically mirrors what we see in consumer cyclicals. And just like in communications, they aren't doing very well, but here recently, they're doing pretty good. And I think that says something. All right, energy. This one is interesting. I said I was going to be curious if there was any negative numbers or in any of these sectors. Energy is it. Energy is your gas, your natural gas, your oil. Trying to think if there's anything else. Natural gas, oil. Pretty much it. Yeah, maybe some. Maybe some. I'm curious. Devon's natural gas, came out as oil. Yeah, Halliburton. Well, Halliburton is they create electricity. So maybe there's some coal or something involved in here as well. But for the most part, it's oil and natural gas. So 80% doing better than they were last year, which is better than 10% the rest of the market. So that's really good. But more recently, though, only 30% doing better than 50. And so you have to wonder what's going on here. Why is the price of energy, the price of oil, the price of natural gas falling? When all the other consumer cyclicals and consumer defensive and communications doing a bit better right now. It's really weird. I can't imagine what that is, but obviously there's something going on with energy. I don't know. I mean, oil and that sort of thing usually moves up when you have like wars and stuff like that, which we definitely have going on right now. There's a lot of gas and things being spent. Um, Consumers definitely for sure consume energy. Um, but if they're paying more for consumer cyclicals and communications, uh, they're spending less on energy. I don't know. It doesn't make a lot of sense to me, but energy sector doing good though compared to the rest of the market. Just um, this past month, just not as good. All right, financials. These are banks. These are also insurance companies. Um, they're positive for September. Not as big as some of the other sectors, but 100%. All of the companies in this sector are doing better than they were last year, but only 50%, only 56% doing better than they did a few months ago. So financials and energy. This tells me that there may be a buying opportunity, right? Because when the share price is not as good as it was recently, but it's better than it was last year, that tells me that either at some point this 200-day number is going to come down or this 50-day number is going to come up, right? So it's something to take a look at um, if if we have an opportunity. We do have to find a new energy company. So seeing these numbers down is really enticing. Looking forward to diving into that. All right, health. This has been a hot topic because of the presidential election. 57% of these guys not doing as well as they were last year. I think it has a lot to do with drug prices and that sort of thing. Also, it's the unwinding of COVID. For a long time, health was really hot because they were just printing money because of COVID and now starting to calm down quite a bit. But recently, 100% all of the companies doing better than they did just a few months ago. That's interesting. I don't know what's going on here. That's a weird one. And again, you can see 11.65 this past month as well, and then another 8% back in July. My goodness. So this one is hot. We do have to get another health company. So that means that we'll probably be paying more for a health company than if we were to wait, because it cannot stay above 50. 100% can't stay above 50 forever. At some point, it's gonna have to come down. Um, but it can stay there for a couple months, especially if this 200-day number continues to move up. All right, industrials. This is sort of in line with basic materials. This is defense contractors. These are equipment manufacturers that make tractors and big machines and whatnot. You can see this huge number here, 13% almost. We haven't beat that 16% yet. 50% above their 200, which is not great, but 88% above their 50. So again, it seems like the stalwarts, the 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 big industrial machine type sectors are doing really well, like health and stuff like that. But consumer cyclicals, not so much. Um, Recently, I want to go back and look at that because, well, 88%. Now that's good. Yeah, same thing with communications. So it's the 200. It's last year. Yeah. So health thing. Yeah. Industrial. Okay. So that's what's going on. So they're not doing as well as last year, but they're doing better than a few months ago. So obviously, I think it is exactly, it goes back to the line here, right? It's like down, 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 right? And then all of a sudden, phew, right? Um, that makes sense. That makes sense. So a lot of these companies are not doing as well as they did last year, but here recently, they've all pretty much came up with some exceptions. Okay, real estate. Same thing, 91%. I'm always shocked to see this. I look at this number every month and I'm always like, real estate is doing so well. 91% better than, than last year, but only 50% better than a few months ago. Again, it's strange that these sectors are kind of broken up that way. And then technology is just not doing great at all. And this is another consumer thing, right? There is another piece of it when you talk about uh, big companies, using technology to make things, provide services and whatnot. So that's part of the equation too. Um, but again, it all goes back to a consumer economy, right? When the consumer economy is good, people are buying cell phones, the company has to purchase technology in order to make the cell phone to sell to the customer. So when consumer cyclicals and communications stuff like this doing good, you expect for technology. Um, and that is not the case right now. But again, that means that this is a potential buying opportunity, right? Um, Usually, when the 50-day is below the 200-day, that means that it's either going to continue down, but at some point it's going to go up. And so the question just becomes, when and how is that going to happen? Um, I can't imagine what happens to drive technology right now, since we've had this AI boom. I think the election may have a lot to do with it. Of course, we have talks about interest rates moving around. So we have some interesting stuff coming up here. All right, utilities, all these guys above their 200, all of them above their 50. This is the hot sector. No one's beating it. Utilities is where it's at. They've been making all the money in stock. In this, from this particular basket of stocks, utilities are making all the money right now. But I don't think anyone has gotten past that 16 number. That was just really hot. And again, this is a relative number. Um, it it's 16% better than the month before. Okay. And I think that's reflected here in this 88%, but still not as good as last year. So I don't know what that says about where we are in the economy right now, honestly, but it does give me some ideas as to how we'll approach getting into some new companies here. All right, what else did I want to talk about? Oh, so yes, we're following the M score dividend portfolio. All right, and this is made up of companies that blow this up. This is made up of companies that have a high M score, and the M score is what I call a management score, because there's some attributes and characteristics of a financial statement that have everything to do with management, not necessarily performance of the company, nothing to do with consumer demand or anything. It's all about how the company is managed, right? And so one of those things, the biggest one is cash on hand. And I just wanted to show you what it kind of looks like. So you can see 50% M score, 50% dividend, right? Make sure this is sorted. All right. So the score you see here, and so the highest score will be at the top. All right. And of course, it's separated by sector. All right. So this is the highest score for basic materials. And you can see the dividend over here. Now, this number is not the actual dividend. This number is a ranking of the dividend amongst this entire basket of stocks. Okay, so for instance, this company has zero point 0.8, which means this is in the top 80% of all the dividends. Their dividend is one of the highest. Go down, we can find like this one is 98. So this is like the second highest dividend out of all the basket of stocks. Okay. Now, the dividend is a weird calculation simply because the dividend changes depending on the share price. Okay. So you have the dividend amount, um, and then that is divided by the share price. So as the share price goes down, the dividend percentage goes up. As the share price goes up, the dividend percentage goes down. So, for instance, just like I was looking at just now, Walgreens, right? WBA. The reason why Walgreens has such a high dividend is because, as you can see, the purchase price in July of 2023 was $29. Currently, the price is $9.25. So the stock price has lost a lot of money. And I don't know if Walgreens has reduced their dividend or not. I'm sure they have, but if they have not, that is why you have such a high dividend for this company. So they call it a dividend trap, where you want to go out and you want to look for just the highest dividend because you know you're going to get paid this dividend, but you're investing in a bad company, right? And just because the dividend may be 10%, if you lose 20% of the share price, then even though you did get that 10% dividend, you still lost 10% overall. So you can't look at just dividend. You want to make sure that you are investing in a good company that happens to pay a dividend. Okay. Where was I going? Oh, I want to show the M score. All right. So one of the biggest things to look at for M score has to do with the amount of cash per share. Okay. And the reason why this is important is because when you have, if I can find a good example here. There we go. All right. So when you have cash per share of $1.13, it means that literally $1.13 of this 25.58 is literal cash. Okay. Unless the US dollar loses, a significant amount of its value, you can be certain that your investment in this company, at least up to $1.13, is completely and utterly safe, right? The rest of the share price may have something to do with their assets and this sort of thing, but $1.13 of it is for sure cash, right? And so, how the cash is managed is a big piece of the management score, right? And so, this particular score does skew towards companies that hold more cash on hand, and that has a lot to do with the type of industry that the company is in. So it is a bit unfair to compare companies based on that aren't in the same industry, right? Because some companies are just going to be cash heavy, like banks. It's like they have a bunch of cash sitting around, um, um, and others don't, right? Because they're just not in the cash business. But again, when you are looking and comparing companies within the same sector, sometimes it can make a big difference. And so we see a huge number right here, CF 11.26. cash per share, current price $78.56. Cash to debt, okay? And so again, this is how much cash do you have versus how much debt do you have, right? And so the larger number here means that you have less debt and more cash. And so you see here, there's a lot of cash, and so we have a big number because their debt isn't so huge that it doesn't, that it's still a big number compared to the rest of these guys. It's very possible that you can have a bunch of cash, but also have a bunch of loans sitting out there to basically make your cash uh, null because you that's cash that you have, but you have to spend it on all your debt, right? So that's another one. What else do I have here? Yeah, return on asset. And so this looks at um, how much you have in assets. So let's say you have a car, and let's just, for simplicity, say the car is worth $100, right? Well, the question becomes, how much money are you making with that right? If you're telling me that that car made you $20 this past year, okay, well, that's a 20% return on your asset. But if you're telling me you have a $10,000 car, but you only made $20, well, that's a horrible percentage. I don't even know what that is, but it's like 0.00% or something like that, right? So I want to know. I don't care if you have a $10,000 car versus $100 car. What I care about is how much money are you making with what you have. Okay, that's what's important. I don't care what you have, but how much money can you make with what you have? That's what's important. I'll take a $20 return on a $100 car before I take $1,000 return on a $10,000 car. You know, $20 is 20%. 1,000 or 10,000 only 10%. I want that 20% return. So that's what this number is, and this also gets calculated again into the management score. Same thing goes with the net profit, right? So net profit again is how much money are you able to hold on to, right? You're spending on assets. You have this debt, right? You're making money. You're paying taxes. You're doing all these things, and at the end of the day, what do you have left over? All right. Now, if you're telling me that you have that $100 car making $20 a year, but then you spend 25 of it, well, that's a loss. You see my point? That's not what we want. We don't want to invest in a company that can't keep money, right? If you make $100 and you spend $100, you haven't made anything, right? So we want to know how much did you actually keep. That is your profit. And so the larger the number, the better the profit. And again, this does change from industry to industry because some industries just happen to be more profitable than others. Um, and in some industries, the profit being small is normal, right? But if you want to take a look right here at the energy sector, you see all these numbers here, point 11, point 10, point 0.05, and then we see this huge point 42, right? Point 23, point 26, point 14, right? The question becomes, what are these guys doing differently? This is Cheniere. What are these guys doing differently than the rest of these companies, right? Is Cheniere in a different industry? Or are they just a completely different business than the rest of these guys? What's going on, right? And again, so this gets calculated into that management score as well. And so for whatever reason, I don't know what it is. I think it may have something to do with because, like I say, the cash on hand is a huge difference maker in that score. And so again, going back to the energy sector, um, you see that Devon and Cheniere both. No. Halliburton. My goodness, Halliburton killing it on cash. So a bunch of cash, but when you look at the return on assets and you look at return on assets is pretty average. It's about what everyone else is doing. But you see that the net profit is not as great as Cheniere. So, that says something, right? Bunch of cash, but no net profit. So anyway, so all this stuff is calculated, and then that gets us to our score here. All right, 50% of it is dividends, 50% of it is the management score, and that's how we want to try to mimic our. We want to try to mimic this particular portfolio. So this is what it looks like. Also, I want to say it's important to note the way these portfolios are put together. Right, they're put together by score. Okay, so whoever has the highest score within their sector for this particular portfolio is going to have more shares allocated to them. Okay, so at the top, you see Energy Transfer, okay, ET. Their score is 0.719. That is the highest score out of all these companies. And so we see here that they have 63 shares allocated to them, okay? The next largest, and then the next largest, next largest, next largest, next largest, okay? And it's actually easier to see here when we look at the stock cost, okay? So it has more money allocated. So $809, and then 670, 545, 475, 391, 307. See, and it just keeps getting less and less and less. All right. And so the company with the lowest score, but still the highest score within their sector for this particular portfolio, gets the least amount allocated. Okay, so $104 at the very end. There's also a calculation for how much cash you start with. I don't really want to go into that one, but it is a computer calculation that only the computer can do. I can't possibly do that myself, but the computer goes through and tries to figure out how much cash should all of these portfolios have to start with in order to have the largest return possible. Okay, because in order to compare all of these portfolios together, they have to start with the same amount of cash. All right, and so the computer does a calculation to figure out what that number ought to be, and you can see here it's $4,020.14. Now, I can change this number to whatever I want. I think right now I have it set between 4,000 to 6,000, I believe. Curious. Yeah, 4 to 6,000 is what it's set at. 4 to 6,000. And like I said, if I wanted to, I can set it, 100,000 to 10 million. I can set it to whatever I want. And the computer will figure out, like I said, how much cash each portfolio ought to start with. And it'll also, like I said, allocate the money divided up amongst all the different companies within the portfolio, with the highest score getting the most allocated towards it. And so again, the idea is that if we had purchased all of these shares in this portfolio in July of 2023, okay, we had purchased all these companies in July of 2023, our return will have been 15%, not including option sales. Okay, not including options sales. And remember, we sell options to purchase shares, we sell options to sell shares. And so that means the return will have been significantly higher, right? This also does not calculate selling shares either, because there's nothing stopping us from purchasing in July of 2023 and selling in October, November of 2023, right? This assumes that you purchased in July 2023 and you never sell anything. That you just hold on to the same companies, and then you will have, and like I say, without even doing any options or anything, you just purchase them outright, just hold them, and you receive dividends. And of course, price appreciation, your return is 15%. Okay, and so we see the purchase price here, and then we see the current price. And as you can see, most of these, IPG is one that we're holding right now, fell in price. Walgreens, you know, huge drop in price. But I have a feeling that a lot of this score comes from their dividend, and they probably have a decent management score. We're actually gonna, well, we're not gonna take a look at it because we're in Coca-Cola right now. Yeah, X, Pfizer, and then Bell Communications, old AT&T, and again, huge dividend for them. So this is the portfolio that we're going to try to follow. All right. And the other thing that we have to look at is performance. Okay. Because I'm also curious as to what is currently performing well. Right. I do want to try to mimic that portfolio, but as you can see, um, everything in this portfolio does not perform super awesome. I mean, now, like I said, this portfolio returned 15%, even losing like what, $20 a share. Like it lost a lot of money on this Walgreens. You know what I mean? Same thing with Pfizer. It lost money on Pfizer. It also lost money on Bell. It just so happens that these three companies are at towards the bottom of the portfolio, so it didn't have a lot of money allocated towards them. So it wasn't a huge hit. The companies that performed better are towards the top and had more allocated towards it. So I'm sure that had a lot to do with the performance of this thing. And so again, I like to see, um, what's performing well, right, and what's not. That's another thing too. If we come back over here and look at all the portfolios, if we look at the worst performing portfolio, is M Score Alpha. Um, Dividend up, yeah, M Score Alpha and dividend up, and this is including dividend. I mean, this particular portfolio lost almost 20%. And the question is why, right? So we know what the management score is. We talked about that. The alpha portfolio, these are companies that perform better than the market when the market performs well. Okay, so when the market is doing well, these companies tend to perform better. And so you expect that, being that we know that this basket of stocks, uh, generally overall, the 50-day has been under the 200-day all year long, at least the last 12 months. It hasn't performed awesome, right? And so it makes sense that this portfolio won't have done uh, very well. The dividend up is, I'm not sure. Again, the dividend is higher because the share price is lower. So that may as well have a lot to do with it. The up portfolio is companies that tend to move up in price when there's a lot of buying and selling. Okay, when there's a lot of activity, when there's a large volume of purchases and sales, and it's a 50-50 calculation. That one lost, almost 20%. The other thing to note here is the statistics. You have a higher chance of losing money on a month-to-month basis than you do on making money on a month-to-month basis. -13 versus 10. So I think that says a lot. And a lot of these, I think, are pretty much in the same boat. Um, M-score return alpha, alpha up moves, uh, beta return is not as atrocious as these guys up here. M score, standard deviation or volatility, and then the straight up dividend portfolio, which literally just has the largest dividends of all the stocks in the entire basket of stocks in that portfolio. And again, dividends are awesome because it's income, money that's paid out to you every 3 months. But again, when the dividend is high, it may be because the stock isn't doing so great. So not always a good idea to invest in those companies. And over the last, 10 years, since I've been keeping track of these portfolios and these numbers, the dividend portfolio is almost always not good. I think I saw it close to the top maybe once or twice. There may be a video on the channel where that has happened, but for the most part, the dividend portfolio almost always performs poorly. The return portfolio is not doing well. The alpha portfolio is not doing well. The beta portfolio is not doing well. It's like I said, these particular basket of stocks, this market that we're talking about here has not been awesome in the last 12 months or so. So anyway, that's that. All right, let's take a look now at performance. All right. MVP. MVP is how many times this particular this particular company showed up in the best performing portfolio over the last 12 months. So this goes back to October of 2023. Okay. And so 7 times MOS, for whatever reason, was in the best performing portfolio. But over the last 12 months, it's lost on average 2% a month. So you have to ask yourself, first of all, why does this company keep showing up in the best performing portfolio every month when it's performing so poorly? I have a feeling that what's happening is this company may be at the bottom of the list in the portfolio, meaning that there isn't a lot of money being allocated to it. And so even though it's performing poorly, it doesn't matter much to the overall performance of the portfolio. And that's why it's showing up so much. This HUN, 3 times it showed up, still losing money. TROX, I think we saw that one in the M-Score dividend portfolio. It's performing well, 2.5%. But the sector best performer is this SMG. And the question is, why is SMG not showing up on any of the best performing portfolios? I don't know. It's very possible that this company is not investable. I'm kind of curious to see if that is the case. Let's see. No, SMG is definitely investable. So whatever reason, it's not showing up on any of the best. So I'll want to take a look at this, right? So what I'll do is I'll look at Trox, because this is the company that the best performing portfolio has in it. The performance is doing well, right? But it's not performing as well as SMG, right? So I want to take a look at these and maybe even NEM as well, because its performance is about what we have here for TROX, but for some reason just hasn't been on any of the better performing portfolios. All right, communication services. We're currently in Rogers Communication, which is 4-time MVP, as barely negative. AT&T and Verizon. Usually the Canadian companies perform better than the American companies, and so it's sort of shocking to see this. I wonder if AT&T and Verizon have been doing bad for so long that now they're starting to perform well, and so on a relative basis, that's why we see these 2 guys with big numbers. But again, that's something that I like to take a look at, right? Like, just because it's not on any like particular portfolio, if it's performing well, let's take a look at it. All right, this one is interesting. Consumer cyclical sector. IPG is where we are. 10-time MVP. That's crazy. 10-time MVP. But as you can see, average return is a negative. And so we'll definitely want to take a look at this high performer here, HRB. Now, we're not selling out of IPG anytime soon. maybe a couple months. I don't know, but um, you know, when we get around to looking at another company, um, HRB might be something that we look into. Yeah, this particular portfolio has IPG in it as well, so I don't know. We'll see what happens here. All right, consumer defensive. Did I just skip over that? I did. Okay, consumer defensive. ADM, um, MVP 5 times. But it looks like the better performer is way down here in Kroger, which I can definitely believe because all this talk about food prices, I don't think it's farmers raising the price. Now, I do believe that their input prices have gone up, right? Like maybe they have to spend more on gas, maybe they're spending more on seed, maybe they're spending more on, machines and this sort of thing. And so maybe that does increase the cost of, corn or something like that. And then you have the middleman, which are the trucking companies and warehouses and whatnot. Um, I don't believe that their costs have gone up much. I know during COVID, I think truck drivers were probably getting paid a bit more than usual. Um, but I don't, I don't know if it's gone up so much that. So the only thing left are the stores, right? Because the stores can name their price. They'll put whatever sticker on a banana that you're willing to pay for, right? And so I have a feeling that a lot of the price increases have everything to do with the stores just trying to make as much money as possible, which you can't blame them. And so there's a lot of talk right now about, just politically around this campaign about bringing down food prices. But it's like, how are you going to do that? Are you going to tell the stores that they can't charge what they want for a banana? I mean, how does that work, right? Are you going to tell farmers that they have to only charge, 50 cents for something or whatever, and then the store can just charge whatever they want? So I don't know if anything is going to come of this. If it does, I think it's a very interesting conversation as to how you make it happen. We already have price controls on utilities. They are talking about price controls on drugs. So, why not a price control on food? I'm just not sure how that's going to happen. So yeah, Kroger, um, sector leading performer. All right, energy. We talked about this. It's really interesting. Um, Energy Transfer, 5 times MVP, and it looks like all these guys are performing about the same. There's literally no one that is performing really better than the other. There's a few in here that's negative, interestingly. Um, Halliburton. We were looking at Halliburton. They got all this cash on hand, but the share price is not doing so well. So, who knows why? I haven't looked into it, but I think that's interesting. All right, banks and insurance. So we have Wells Fargo, Regions Financial, Blackstone, AIG, insurance company, and all these guys are doing awesome. But I think it was what 100% of all of them are above their 200 day. And you can also see that the MVP is spread out. And whenever I see this, what it means to me is that there really is no sector leader, right? It means that you can literally close your eyes and pick any of these companies and they're going to perform fairly well. You know what I mean? You can't really pick a loser right now when it comes to banks and insurance companies, which means that, our position in Regis Financial is probably solid. You know what I mean? We don't have anything to really worry about. It's probably going to go up and down with everything else. But we do see a few like oversized returns here. 3.5 for Blackstone, which 3.2 for Truist, 3.2 for Citi. Um, I don't know what that can be about. I think it has a lot to do with has a lot to do with the interest rate thing. Um, I think we have not seen any like problems with credit. I think that for the most part, everyone is up to date on their credit card bills and home payments and stuff like that. The economy is doing well. You know, there's some talk about the unemployment number going up, which is actually something that we want to see because we want to be able to bring interest rates down, right? So the interesting place that we're in right now, and the fact that the banks are doing so well, I think says a lot. You know, there's no one worried that the bank won't be able to pay out their deposits. Banks are flush with cash. The stock market is doing well. A lot of these banks are also um, investment banks, right? So they're invested in the stock market and they're advising and investing for people and stuff like that. So guys are doing awesome right now. All right, healthcare was an interesting one. Um, looks like Organon and Fastenal. Wait, no, that's industrials. Yeah, so it looks like Organon is the sector leading performer, and we talked about that. Organon is a orphan stock for us. That's the only reason why it's on this list. It's not an investable stock for us. We cannot invest in Organon. That's the reason why you don't see it on any of the better performing portfolios. But it is interesting to see that it is outperforming everyone else, right? And so investing in healthcare is going to be a tough thing because none of these guys are performing very well. Let's take a look again at the sector overall. Just curious. Yeah, 57% below, I'm sorry, above their 200-day, but all of them are above their 50-day. So the fact that they're all doing better than they were 2 months ago, but they're all performing poorly for the most part, with the exception of literally Gilead, um, is I don't know what to do about that. It seems like either they're doing really well and will continue to get better, or well, I think that's yeah, I think yeah, or or that 100% number is going to start coming down, and the percentage above 200-day is going to either stay where it is or worse, fall as well. And these negative numbers are going to get bigger and bigger. And there's only two ways it can happen. So finding a healthcare company to invest in is going to be interesting. Um, you know, with these negative numbers, like I say, Gilead, uh, best performer. I don't even know if it's investable. I think it is. Um, and then the negative Pfizer, which is actually what the M-Score dividend portfolio has. It's there, and we've been in Pfizer before, so it's a decent company. And like I said, they gifted us a share of Organon, so be kind of cool. I like going through the Pfizer quarterly report because they talk about all of the drug trials and all of the diseases, particularly concerning cancer that they're involved in. And I learn a whole lot listening to those earnings calls. All right, industrials. Again, this one is sort of spread out. Fastenal sector leading MVP. HNI, my goodness, 5.78. So I'll definitely want to take a look at that one because we do have to choose an industrial to go into. I HNI is a new one for us. That's a new one this year. So I don't know anything about the company. And then TRN is another one. And then, of course, Fastenal is the MVP. And I believe Fastenal is what's on this portfolio. No, it's not. TRN. Okay. So that's what we'll have to look at then. We'll have to look at TRN, HNI, and maybe KFY too. Maybe. We'll see. Real estate. All right. GLPI, sector leading MVP. And then sector leading performer Macarich. Macarich, I don't believe. Oh, it is invested. Oh, I'm gonna have to double check that to make sure. Um, but yeah, this is the company that we purchased. This is the first company we purchased back in 2014, 2015. And back then we didn't have a lot of money. So we literally purchased one share. And um, and I remember the stock price was like $80. Okay. Matter of fact, see. Yeah. $82.81 is how much we purchased this company for. We paid $7 in commission back then. And we purchased one share. And so instead of selling Macarich at a loss, what I decided to do was simply purchase a different company in the real estate sector and just hold this one share as as an orphan stock. And so it'll be interesting to then go and purchase more shares of Macarich. Um, the problem is for the accounting, it will show that we have one share of Magarich at $80, and then let's just say we purchase um, a second share, right, at the current price, which I believe is something like maybe $20, maybe even less. Let me see. And this is just like the math of how this works. All right, yeah. So see, it's only $15. So the way it'll work is you do $15 plus $80, which is 95 divided by two. That comes up to something like $47.50. So we'll have two shares of Macarich at $47, okay, and the share price is at $15. So there's no way that the share price is going to go up high enough to make it to where we have a sales signal to sell our Macarich shares. We'll have to purchase so many shares of Macarich to bring our overall price down to make it make sense. Um, but again, that's like funny accounting stuff. Um, and so I don't know, but yeah, I mean it's sector leading performer. I like Macarich. They own a bunch of malls, and so the that story has been interesting when you go all the way back to like 2015, back when they were closing down a bunch of malls and stuff like that. And now the malls is not even like a conversation. It used to be though. It used to be a big conversation about what are we going to do with all these malls, and now we're pretty even on the malls. Um, None of them are really in any jeopardy. All right, technology. All right, again, really spread out. No real leadership here. But we do have an outsized performer here in GEN, which is pretty cool. We're currently in Corning. It's at a respectable 1.86 per month. And then also JNPR at 2.7. So we're very close to getting out of Corning. And so definitely we'll take a look at these two. And I forget what's in Hewlett Packard, HPQ. Okay, 138. So yeah, we'll take a look at some of these performers and maybe Hewlett Packard and see what we are going to. Man, look at this huge number here, 28% back in July. Goodness. Um, all right, and then utilities. This one we know is doing like super awesome. I expected the MVPs to be spread out, but no. EXC, for whatever reason, has consistently been on the best performing portfolio over the last 12 months. And its number changes every month, right? Because every month you lose the oldest month and you have a new month. So next month, instead of October 2023, the current, it'll be November 2023, the current. So these numbers are going to change every month. And so I love coming in here and just kind of keeping up with it. See, best performer, 2.5% PEG. They've been around for quite some time in our basket of stocks. And then Southern, same thing, been around since the beginning in our basket of stocks. I don't think they've ever really gone anywhere. But yeah, but all these guys are doing really well, and we definitely do have to choose a new utility company. So um, I'll definitely grab. Oh, look at this, and then EIX is okay. This is EIX here. Okay. So yeah, so EIX performing better than EXE. Um, so yeah, I'm gonna kind of curious to see why they're on the best performing portfolio, but either way, I definitely want to take a look at these others too, PG, Southern. I don't think you can really go wrong anywhere in the utility sector right now, honestly. Um, but all right, now let's take a look now at the portfolios, and I really like um, this color chart here because it's a difference looking at numbers, right? Numbers is one thing, like one number is bigger than another, and you can kind of just make an easy, concrete decision based on that. When the numbers are similar, it's a bit more difficult. But when they're color coded like this, um, for me, it makes all the difference because what I'm looking for right now is more green, less red, right? If I see a lot of like light yellow and light green, that's not bad. But what I want to stay away from is these dark reds, right? And so this is the alpha portfolio. We talked a little bit about what that portfolio looks like as far as performance and numbers, but you can really see here in the in the colors. But also, again, talk about volatility, right? We see this dark green number here, 6.5%. Here's to see what the largest number is going to be in all of these. So this one actually looks decent, even though this portfolio did not show up very well performance-wise on our list of numbers. The colors don't look bad, really don't. Standard deviation volatility portfolio looks about what you expect it to look like. There is some reds in here, but for the most part, it's pretty yellow. Um, this one doesn't look too bad. I like to see all the greens in here, um, but then you see these dark reds. And so this is what I'm talking about. This is how I know the portfolios are scored properly and they're working properly because this is the dividend beta portfolio, meaning that these companies perform well when the market does not perform well, right? And then paired with that, you also have a dividend being paid out every 3 months. And so as you can see, this particular month, this is November 2023, the stock market must have just took a big crap, right? But even in the worst performing month of the year, probably, um, this portfolio scored the best. Well, we don't know yet, but I think it did because it's really dark green. And so even though it lost 5%, it's still way better than the rest of these guys, right? And that's what you want out of a beta type of portfolio, especially when you marry the fact that you're going to get paid that dividend no matter what the stock market is doing, no matter what the individual company share price is doing. You're still going to get paid that dividend. Uh, Dividend return doesn't look terrible. This one is horrible. Oh my goodness, dividend up. This is horrible. Can you imagine owning this portfolio and every month it's just like 10%, 13%, 8%, 3%, down 7%. Like that's crazy. That's horrible. Um, yep, 6%. I'm still looking for like the highest number in here. 664 is pretty big. And see, look at this. It's not dark red because this is, like I said, one of the worst months for the entire basket of stocks. Um, so negative 10%, which is still a shade of red, but it's not the darkest. This one looks really good. Return up. There's some kind of nasty reds down here more recently. Up here though, man, thing was throwing down some bank. Oh, look at this one. Very, very dark green. Almost 7%. My goodness. Um, do see a couple reds in here, but nothing like super dark. So it's a good looking portfolio. Alpha up. Um, I like this one too. It doesn't perform as well as this alpha up. And this is really dark. I like that. And I think this might be our largest number, 699. This one is weird because it just looks like a kaleidoscope of colors. You have a dark green right next to a dark red. One month is the best, one month is the worst. Um, this one looks horrible. This one doesn't look bad, except for this one blemish. And then another kaleidoscope. These don't look bad. This one looks good. And this is it. M-score dividend. Yeah, this one looks good. And like I said, it's interesting, right? You can look at the number and be like, oh, okay, this is for sure the best performing portfolio. But seeing the colors is different because even though the color on this looks good, there's some other portfolios that look as good, if not better, to the eye anyway, right? Because it's these lighter shade reds right around here that aren't so awesome. But you see this sort of like olive green stuff all around here. It looks pretty good. Another horrible one, M-score alpha, kaleidoscope. This one is not terrible, but there's like no dark green at all. We have a new, this is the highest, so 7.5%. And so again, this goes back to our volatility. So I'm curious now, let's take a look at the volatility. We see another big number, -9, almost -7 here. But let's see, M-score alpha up, M-score alpha up, M-score alpha up. Here we are, right here at the top. And yeah, we see -9, M-score alpha up. So it's not, yeah, it's nowhere near the top of the list statistically. But it is still, you're more there's a more possibility that you'll lose money versus make money on a month-to-month basis. But it does not necessarily look like that with these colors. I mean, there's a lot of red in here and then a very dark green. So you think that that's going to mean a lot of volatility, but it's not even anywhere in the top 10. Yeah, it's not even top 10. So the top one is M-score alpha. Let's take a look at that one. See what that looks like. M-score alpha right here. So yeah, see, to my eye, this doesn't look super volatile. It looks like a horribly performing portfolio, for sure. And I guess like, you see this large 5% right next to the -8, but it's not a great performing portfolio for sure. I just didn't think it would have been like the number one, um, most volatile. Um, so anyway, so I like to kind of look at that stuff. M-score dividend looks really nice, really pretty green, no dark reds at all. Like I say, a light shade of red here. And, there's a couple other portfolios in here like this one that look really good outside of this one blemish here. And then the other thing that I look at is, again, numbers, but this is looking at every 3 months. So this is literally an average of 3 months. And the reason why I have this calculation here is just to give me kind of a trend of what's going on, right? So if we go, let's go back to M score dividend. Let's just see kind of what that has done. So this is, I'm gonna, so I can get the date. All right. So this is April to July. Okay. Between April and July, this thing returned 9%. And then May to August, almost 4%. June to September, which is the most recent 0.6. And so what I look at is what is this thing, where is it going, right? Number one, is it doing consistently better or is it doing consistently worse, right? And then how does that look relative to the rest of the portfolios, right? So we see through here, there's a bunch of negatives. And of course, I don't have all of them showing right now, but the point is, it's been consistently positive. And that's good to see. But again, is it losing steam? You know what I mean? Is it getting better or is it getting worse? And so that's important as well. Let's try to look and see if we can find any other portfolios that kind of look at this. Look at this. 6, 2, and 3. My goodness. This looks good. 6, 2, and 3. Now numerically, it's not as high as the other portfolio, but it looks darn good. Looks darn good. And if you come up here and look at the colors, I think this is one that I looked at and saw, no, not great. Not at all. Not at all. I mean, look, there's a lot of red. Doesn't look good at all. But then you see these numbers and you're like, this thing is consistently doing well. Yeah, there's nothing else. There's nothing else. See what I mean? There's nothing else. Everything else is either getting worse, consistently bad, or just not as good. And so it's really interesting. Well, here's one. Um, Standard deviation down. And this one looks good to me. I like this one. You know, it has this one little red here, but the rest of it looks decent as far as the color goes. And so, like I said, I keep tabs on this stuff, and then throughout the fiscal year, I'll come back and look and see. Okay, maybe the M score dividend portfolio started out well, but maybe it's not doing it, so good. Maybe it's you know, and so we may switch in the middle of the year, right? It's possible. Um, and so that's why I keep tabs on that stuff. All right, what I want to look at now is these are the companies that are inside those portfolios. But this is the best performing portfolio for the month. So in October 2023, this particular portfolio had the best performance. Okay. And see if we can find it real quick. 1.27 might be, nope, 6 is bigger. Looking for dark green. I think, there we go. That's our dark green. So the alpha portfolio. So these are companies that do really well, that do better when the stock market is doing well. Okay. Now, what's interesting is these companies here may show up on other portfolios. And that's how we end up having companies show up 8 different times in the best performing portfolio, is because they are in, the same company can be in multiple portfolios. And they're color coded for their sector. Okay, so the yellows are all going to be energy. And for instance, the purple is going to all be communication. And so again, looking at the MVP on that table is a number. You can make a concrete decision about it. Seeing it in color, though, makes a difference in my mind, right? The other thing to keep in mind, too, is that over here, these are the companies that I talked about that are at the top of the list in those portfolios. Okay, so these companies have more money allocated to them for these portfolios. As we can see, this first list here are made up. Now, this is the last 12 months, okay, are made up of mostly energy companies. So that means on a month-to-month basis, the best performing portfolio is going to have an energy company with more money allocated towards it, right? Um, and that says a lot about what the energy sector is doing. Same thing if we go over here to the last column, okay? These are companies that have the least amount of money allocated to them. So if these companies don't perform as well, it doesn't matter much to the overall portfolio, which is also a strategy, okay? Because guess what? You can't win everything every month. You're going to have losses. The question becomes, when you have losses, how much do you lose, right? And we want to lose as little as possible while making as much as possible, okay? And so we see the white, the GLPI, that's going to be real estate, okay? IPG is going to be consumer cyclicals, the orange, and then the purple is the communication. And almost all the purple is on the back half of these portfolios. That says something, right? That says something. It says that our portfolio ought to also mimic this, right? Where we do not allocate as much money to those communications companies. We need to be putting more of our money into these energy companies. That's where the money is being made. Okay. I don't really see any other congruencies. Of course, there's going to be some exceptions in here. Um, this row, remember, is the worst performance of any month over the last 12 months for this particular basket of stock. And this particular portfolio lost 5%, but was way better than anyone else uh, in the market. And so these are those companies that made up that particular portfolio. So yeah, other than that, I don't really see a lot of other congruencies. I think the green, most of those are on the back half as well. There's a few that's sitting over here on the left side, but and green is utilities, and which is interesting because we know that utility sector has been doing really well performance wise, but I don't think it holds a candle to energy overall. Um, so yeah, so really excited about getting our new fiscal year started. Excited about finding some new companies to invest in and doing some comparisons and seeing what this fiscal year has for us. Right now, we're sitting at about 1.6%. And so we are really on track to beat our benchmark this year, the Dow. And yeah, that's it for now.